The following is a presentation of TFNN. The Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Technicians Hour. My pleasure to be here Monday through Friday. Market days 11 o'clock till noon. Dow's up 11 at 16,750. S&P's up 165 at 1996. Comp index is up 12 at 4902. This is going to be very interesting because yesterday gold had a very big spike to the upside. It's holding that gain. It's only down $1.50 at 11.17. Silver is down. Silver's up 12 cents at 15. Platinum's down. High-grade copper is at 2.46. Crude oil is at 47.42, down 9 cents. Bonds are up 10.30 seconds. The TLT is up 10 at 118.90. Fascinating market. Dollar is down again. Dollar's down 16 cents at 95.38. So what do we have? Great analysis earlier on. We heard Larry, we heard Tom just discussing in great detail their particular the aspects that they are following as closely as possible. A couple of things that I thought were very important about yesterday's action. Number one was that there was a concerted effort to move up very little pressure to move down, and as a result, the E-minis daily went to leg C with quite good technicals. Stochastics is 87%. That's good, but look at the way the MACDs had to struggle to come back with the lines above the 0% line, but the actual 0% line is very positive itself. So what that's saying to me is let's look at the bigger picture, and I've spent a lot of time on this only to discern whether or not we're looking at a marketplace that says within the context, for a moment, let's eliminate, of course you can't really, but let's just eliminate the Fed speak coming up at 2 o'clock. If I was, what I showed my subscribers, if I was looking at this pattern right here, not that one, this one here. If I was looking at this pattern and I was doing an analysis of it based on the formations, what patterns repeat, what happens when they don't repeat, or what happens when they partially repeat. So let me look at this and let me explain to you what I'm looking at in terms of merely the pattern that is formed, number one, the pattern with the expectations of what one normally sees, and what the difference was with the last 2 days, not today, but the previous 2 days of rallying, and what that means. Here we go. The pattern I always talk about, and I'll just draw it in right now, is really the H formation. It goes like this, comes down, has a pretty much straight line move to the downside, and then it makes an arch formation, whatever it is that you're following. And that arch formation invariably wants to come back and retest the low. Well, in this case, you went to 50,370, and then we rallied back up. I'm just listening to this. We got these robocalls because there's an election here in Newton, and I keep saying to myself, wait a minute, what happened? Surely we should not have to get robocalls with politicians. I mean, why did they get exempt? Is this the same as the Senate and Congress? They get all those benefits and nobody else in the world gets, but they get it, and then they vote on other things? All right. H pattern, lowercase h pattern, made a right side test that was way above the 15,370 level. Fine, that's the H. Then very often, if you're going to be in a trading range, or you being the whatever it is we're looking at, if it's going to be in a trading range, it'll make another arch formation. So you've gone from a lowercase h to a lowercase m, just keeping it as simple as possible, just talking trading patterns. Within that context, we did that. We made an H, And then we made a little smaller one. Let me just do it this way, just to be very precise. I've lengthened it for other reasons. Right there. And then we came back and saw a retest, and that retest again was higher. Now, something's happening, because if you get a retest and the retest is higher, it says that there was strength. Well, then there was another H pattern right there. And again, it went to a slightly higher high, and it came back and retested, but the retest was higher. So I drew in the dashed pink trend line. And then what happened? We went sideways using the 9-period exponential moving average, this maroon colored moving average right here, and turned it into a base. So instead of having what very often happens with the arch formation, is comes back and it tries to retest, but it breaks the low. That's very important. There are a whole bunch of connotations. If, in fact, there isn't a retest of the low, but what there is a higher high, and you start to make higher lows like this here, then all of a sudden you say, okay, we're in a rectangle formation. That rectangle formation can go to the left side arch formation high of 16,669, in this case right there. But if it pierces it decisively, you've got to consider that you've got yourself a rising up channel, and I drew that in a few days ago. So that makes today's new recovery high, leg C extension, very important. If there was no Fed speak whatsoever, my assessment would be is that we're going to make it leg C to a peak C within another 2 days, pull back, and if the 16,530's 9-period moving average support level survives, then there should be a leg D, and at that point you've got a whole new ball game, because you've got the rectangle formation that would be formed right here. I could make it bigger, but I've kept it narrow for the moment, and it could go to, on the upside, it could go all the way to that trend line right there, and that's at 16,990 in the Dow. But all of that was kind of irrelevant, because while we were short a small position, we got taken out because I did not want 16,990s to 17,000 and 16,720, I should have said, sorry, was really the upper limit. I didn't want to be involved at all on the short side if we were going to get there. Well, we got there yesterday, went to 16,755, and today our high is already 17,000. I keep saying 17. I mean to say 16,761, slightly higher. But this is the issue. Look at the way the MACD histogram has been rising. Look at the way MACD itself has been climbing nicely. And the stochastic finally went from the 70s, bam, it's gone to 88%. That is good action. Regardless of what the Fed does, the market is saying at this particular point that there's tremendous support in the 16,530 to 16,470s. A close below that could change the pattern. But up until now, that's what we've got to consider. And at the same time, there seems to be a cap in the 16,700s. And this high right here of 16,990s is going to be that in fact has turned into a resistance level that we've broken above. Wrong candle. Sorry, this candle right here. Wait, how can that be 16,000? Oh, yeah, that's right, 16,990. I got to get rid of that 17,000. Maybe we're getting there today. Just get it out of your mind. Keep saying 16,700s. So yes, a break above says that this trend line right here could take you by Friday or Monday to that level, the high of 16,990s. That's really what I was trying to say. Okay, now forget the Fed for a minute. And let's do a couple of other things. In the SPY formation that we've been talking about for a while, what I mentioned was that there was a volume spike. And that volume spike was very important in my work because it says, this is that volume, it's called, let me just move this over right here so you can see it. There you go. And I'll open it up, the chart, so you can see it. It's called the price volume spike low. Actually, I call it the Chapman wave price volume spike low because it's something that I've worked a lot of hours on. And we're going to see, we have a test right now. I should have believed it right away and said, you know what? I don't care about that VIX index screaming up to that 53 level. It was an aberration. There is enough strength here to say that it doesn't give you the height, but it says that you will not come and retest the 182.40 level made on the 24th of August in the SPY for quite a while, and that there should be a rally of time more than price to the upside with the 204, 200 period exponential moving average area, not the price itself, but that area, point below, a point above, 2 points above. The 200 period simple moving average is at 207, so it's 2.5 points above. But that area could, in fact, be the arch formation that forms before we start to do the retest. And the retest just says that you'll start to go down. If you accelerate lower, you have to really clear on the downside. In this case, 190, I believe I said it was. 190 on the downside, that's 10 points. That's a lot of points to the downside before you're going to even think of going to the 182.40 level. So let me move this away here. So far, all the assessment that I've made says, if you include the fact that the TLT has pulled back sharply, is very close to supports at 118.92, and that support that I'd be looking at here is this trend line right here, going to a low tomorrow to test the 117.66 in the Lehman 20-year T-bond fund, then all of a sudden we're looking at this and saying, aha, we've got a little bit of insight into where support has to be in the TLT, because if it closes underneath, if it closes anywhere in the 116s in the next 2-3 days, that says bonds, that says the TYX. TYX, can I go back there? No, I can't. TYX should extend this leg D, and the weekly chart will extend this leg A, and the monthly chart, it'll maybe even scream over the 32.55 level back in June. That was the high of the yield. So this is really a very important moment. Now, in a way, Tom stole my thunder, because I was going to say, with all this activity that we're looking at right now, there is a chance that the Fed comes out and says, we will be raising rates in September at the next meeting. We will be raising rates at the next meeting, and this is a warning. Something like that. Something which the market is not really expecting. And that could get this real whippy. I always talk about the dog. It jumps into the water at the beach and it comes out. And what does it do? It shakes itself and shakes and shakes and shakes and gets everybody wet, but it really goes nowhere, but everybody else is wet. Who knows? Maybe we get that. I'll talk about the downside in a moment of the market and what could take it down.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. months. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Basil takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
So, folks, I had a question about BNDX. That's the weekly Vanguard Total International Bond ETF. You know, this looks like made a doji peak E way back in, that was April, I believe. It comes back really sharply from the 54s, pulls back to the 52s and bounces up to the 53 and a quarter. Now it's trading at 52.61. Looks like the arch formation. So when it comes to the yields, there is absolutely no reason why, if there was an opportune moment, that the Fed doesn't take it right now. Okay, let's just get that out the way. But most importantly, let me go through something that I was talking about. If I can get the daily, weekly, monthly, that wasn't the one. Let me get out of that. I wanted to show you something here. And this, to me, it makes it quite important. To close workspace, yes to all. And now we're going to go to long-term charts. Yeah, look at this. This is the 30-year, 10-year, and 5-year yields. Notice that after the peak E at 32.84 back in March of 2013, there was a sharp drop, went to a trough B, and then what did it do? It rallied sharply. And in fact, exactly right here, look, there is exactly the same chart formation, E. And then what does it do? It pulls back and then bumps up against this great trend line that I drew in, where I said we've been here so many times before over the past 4 or 5 years. Now what's really important is that broke out and went A, B, C, D, E, and then it pulled back and even went to an F, and then collapsed and came all the way back. Still never took out the 16.14 low, I believe. Yeah, look, that is the 16.14, 16.51 on the 10-year, and 22.28 on the 30-year. So that did go to a lower low. Yes, that's it. Oh, this is so interesting. So as I see it right now, this is a very critical time, because within the trading band, after a peak E and you make a sharp pullback, there is often a rally back up. Is that rally back up going to take out the high or the last high? In this case, it was 32.55. Last time it was just 32.84. Because if it does that, you could get quite a big move to the upside. So as I look at this, I gave the positive side for the market. What if money comes out of bond funds, out of bonds, and then goes into stocks? Well, that's going to help the stock market. So the reason why I say this is very critical is because this is also a level where we've reversed often enough. So let's have a quick look. You remember WOOD, that was the iShares Global Timber and Forestry ETF, failed miserably from 56.69, goes down to the 45s, and then what does it do? It just goes sideways. The Philadelphia Housing Sector Index, HGX, has gone where? To a peak D, pull back, didn't take out the low on the left side of May of 2015 of 218.63. It went to 220.07. Now it's bouncing. So this bounce is going to be really important. Is this a rally that takes you above the previous high, all-time high? Is not all-time high, the recent recovery high of 250.220? That's a big question. So I want to now take you from these charts, and I want to take you to something a little different. Within the context of what I'm looking at, you have to ask yourself, are conditions that the Fed looks at conducive to the type of spike in interest rates, not just the quarter point, but a continuous upgrade of yields? Is this the environment? And my contention is that even if I set aside my Japanization of bond yields mantra that I've had for so many years, it seems to me that the Fed, and this is what might roil the market, the Fed is still looking at many negative aspects of the economy, the way they read it, that is. Whether it's reality or not, that's not the point. The point is the information that they get, and from that information they glean, they make decisions. And my thinking here is that there is a chance that the Fed, in fact, doesn't do anything, or does it in such a way as if to say, well, we're just about to raise rates because, and then they'll name a couple of things, but those things are only marginally better. That's going to be very interesting. Why? Because in the chart patterns that we're looking at, if I'm correct, it's saying that that SPY indicator that I have says that we could hold quite well for 28 days, 28 consecutive days, without retesting the lows. Let's look at it in terms of chart formations as soon as we get back. That's what we'll do.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Technomental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. We're back looking at VWA, Vanguard FTSE Emerging Markets Index. Look, it went to a beautiful peak D. The low was in 2008, and then it goes A, B, C, D, and screams all the way from the lows in the 1819 area and goes all the way to 50.92 in May 2011. So it goes from 2008 to 2011. Now it looks like a commodity chart. This is the emerging market. So you've got to be real careful. Have I updated my EEM? No. EEM. EEM chart. Yeah, it's the same thing. You look at this iShares Emerging Market Index Fund. Now, let me talk about candles since this came to my attention right as I was talking. This candle here is a Chapman Wave Roman candle. You get halfway into the wick, watch out. You can take out the low. It took out the low. It went all the way down from the 48s down to the, 33, 42 area. Then it rallies and goes peak A, pulls back, arch formation. Peak B, arch formation, pulls back, makes a slightly lower low, but it went to a slightly higher high. So it says they could bounce one more time. Bounces one more time, it goes to C. And it becomes a C minus because you took out the left side low bar of 33.42. That's kind of the pattern I was looking at for the Dow. Look, down, arch, lowercase m, another M, maybe even a bigger one if you put it into that context, and then it retests the lows. That fits in with the SPY pattern of 28 sessions, which takes you for about another couple of weeks, a little longer, going a week or two, was it 10 days or something? Excuse me. And then we get to see what's going on. So yeah, we are. This is let me just one more time go back to this chart, INDU, and that says, so without the Fed, I would have said sharp pullback suddenly out of the blue, makes peak C, but then there's a rally up again to a nominal D in the 16,800, maybe 16,000 16,900s, but 16,800s. And then you start to arch over and come back down. And that makes the weekly arch formation, whether it takes out the low, whether it's a high level consolidation, then it breaks out to new highs. That's another thing altogether. So that's what I'm looking at regardless of the Fed. Let's go to Mark in Denver. Mark, how are you?
Good, Basil. How are you?
I'm well, thank you.
Hey, I just wanted to clarify something. Maybe I'm confused and maybe I don't understand how you use this particular gauge. But I was under the impression that that the low trend readings called for a potential rug pull within 1 to 2 sessions, and really high trend readings called for the opposite. And then I think in your overview today, you said something about a 7 to 9 point rally because of the trend from yesterday.
You know, you're absolutely correct. What I should have said, what was the low then yesterday? 0.34.
Right.
What I should have said, that regardless of what the Dow closed at and whatever the futures are indicating, there should be weakness in the Dow in the early morning. That's what I should have said. Thank you so much for correcting me. I don't usually make that mistake, but I did then. And,
I was like, what am I reading?
yeah, what you were reading was totally incorrect.
Okay, because I thought
it was the exact opposite. So absolutely. Let me just get rid of this frog in the old throat. Hold on a sec.
So did you think that we kind of got that, or are you still waiting for some more?
No, the Dow went negative this morning.
Right. But I thought it was I thought you were thinking like a 7 to 9 point. I thought you said a 7 to 9 point drop in like the S&P is your typical.
You know what? All I would have said is that regardless of how high the trend, the S&P futures would be, based on this particular index, the relationship is in this case to the Dow,
right?
And the Dow should be negative.
Okay.
That's all it says is negative. Sometimes I have other indications to say sharply negative, but the most important thing is with yesterday's action, they looked just for a moment like they might be followed through to the upside, and then all of a sudden you saw weakness in the Dow.
Yeah, because the 2 prior days, the trend went one day it got down below 50, I think 2 days ago, and yesterday it got down to 0.3 something. So I was just curious as to what that was calling for.
Yes, absolutely. Let me just double check here. Yeah, the previous day was 0.48, but this is the one I treated this 0.34 as the low trend.
Okay, great.
Good point, good eye, and thank you so much for correcting me. You know, as I was writing it, something said to me, hey, is that right? Is that right? And I said to myself, of course it's right. I mean, I'm writing it. Why should it be wrong? But in fact, you're absolutely correct.
Okay,
so thank you for pointing that out, and we've already got it. So it's another success. I don't have to put. Look at this particular index here. I scratched it out there and there. That was back in July the 9th and July the 10th. Other than that, there have been no scratches. It's worked virtually every time. There was one I might have missed much earlier on, where it should have been a pullback. And there was a massive pullback intraday. The Dow was up like 350 points. And then it came all the way down to minus 43 or minus 28 and then closed slightly positive. That was a miss, even though it was an unbelievably good trend flashing signal. But it didn't work because it didn't go negative.
Okay. Okay. So I don't know if you mind me asking, but what do you consider to be a high trend and a low trend?
I absolutely don't mind you asking. You can ask as much as you want, but the numbers I'm not going to give out.
Okay. Okay. I mean, I think I can guess from following you long enough.
You're following me long enough, you'll be able to figure it out, but I'm not giving them away for two reasons.
Fine.
I said before. One is I just decided that I was going to keep this. I worked too hard at it.
Yeah.
I'm going to keep it to myself. It's not a black box. It's a specific. There are two specific numbers, and the one on the upside, on the one side is one number, and one downside is another number. That's number.
Yeah.
That's part A. Part B is these numbers are bound to change because they did change once before.
Okay.
And I don't want people getting all worked up on these numbers when, in fact, all of a sudden they change and they don't know that they've changed.
And I've heard some people like Tom talk about like a 5-day, number, when you add up the 5 days of closing trend values versus.
That's the beauty of having these different indicators.
Yeah.
For instance, Steve Rhodes has taken a number of indicators and he's worked them into his own methodology. That's the beauty of these things. These are just, nobody can have a proprietary thing when it's really a mathematical formula that's worked out.
Right.
And if you use it in a certain particular way and it gives you a percent, you've got to have a very high percentage of success. Otherwise, it doesn't work at all as an indicator. But if it does that, it's like I always say, if you get out of bed every day on the left side and the market's up and those occasions you get up on the right side, the market's down, you want to use that as an indicator, good luck.
Well, yeah. No, it's really nice that you guys all have your little tools, and so I put them all in my toolbox and use them to help me as well, and it's all been really good. So
I think it does make a difference because it allows you to get a perspective
right.
in an area that perhaps you weren't even either aware of or you just weren't focusing on before.
I knew nothing about the trend before I started listening to all you guys. So
and as much as I read and I look at the formulas and everything, at a certain point I use my own methodology so much that other stuff just goes out the window. It's just gone. I have to actually reread it. Some of these things I've reread are like 30, 40, 50 times.
Right.
But because I do it my way, then the original methodology kind of goes out the window. Not that I don't do it initially to get a feel for it, but at a certain point, if it's working in the direction and the method that I'm using, then that's successful.
Hey, can I ask you one more question?
Sure.
So, what's your? I've been playing this IBB. I actually have been real successful playing it to the upside until a couple days ago, and then I got out and looking on the short side now, and I'm trying to. Because it looks like it's made a D.
Yes.
And I'm wondering how many more legs do you think this thing's got in it before it comes maybe back down to the 330 range and test those?
That is an extremely good question. The reason why it's a good question is because if you look at this is kind of the pattern that I've been looking at. Because of that aberration of the 24th, where the IBB went down to 284 and the high was 400, that is a huge move for this particular index or sector. The most important thing is it's taken all this time from that spike low, volume spike low of the 24th, 4.8 million the day before was, so 4.87 the day before was 4.85. And when I look at that and I say, okay, let's give you back the following day and treat the following day, make it halfway, make it somewhere that the real low should have been 325 and the rest was just program selling. If you look at it that way, the move that we've had up now, if you look visually at the weekly chart, it looks fantastic. But if you take away that spike, what I would say is that, wow, you've got a stochastic at 92, you've got a MACD really strong. Why is the price not at 368 to 373? There's a real good reason, in my opinion, and that is because you now have sellers, big block sellers. If I'm reading this correctly, you've got the big block sellers going out. They're coming out of their big positions in these biotech stocks. Doesn't mean to say that it has to crash, but it says slowly but surely. I think that this candle, I never kept talking about the candle that I was looking at before on the chart that I had. Was that V? I'll look at it in a moment. But this candle, this Roman candle, is formidable because it says that if at any point the IBB breaks, it's a 357. If it trades any week, 2 to 3 sessions at 320 or lower, there's just a real good chance that that is the moment that it's going to start to break down and go towards the 284 level. That's the technique that I use with this particular candle. So holding up like this says, yep, you're holding, but you're not leading. You're not a sector now that's leading the upside. You're a sector that says, gee, I'm struggling. I hope I'm going to be able to make it. So by the end of the day, if whatever the Fed says, if instead of just spiraling to the upside with a 200-300 point move or spiraling to the downside with a 300 point move, if in fact over the coming 2 sessions we see that the market is just kind of holding steady, maybe a little bit up or maybe a little bit down. The IBB is going to be a great clue, because if there's any release of, if the interest rates remain low like this without the sign of going up, then there's a chance that the IBB, because from what I understand, these biotechs really do loan a lot of money, and interest rates are very important. So if that's the case, we're going to see, because if the IBB starts to scream into the 363, 365, 368, and in 2 days it's up at 371 or 2, then I have to say, wait a minute, there's something here, there's a change of scenario. I had my caller the other day calling in and say, is it possible that we've seen the low and not a low? Well, those weren't the words. That's my interpretation. And my answer was, at this particular point, I still have to consider that it's a low, and that we have to expect later on a test of the most recent lows. And that will be really important to answer your question, because the IBB has been a big part of it. If the IBB starts to fail, it kind of limits the upside for the Qs and a number of the indexes. If it starts to rally, it'll help the Qs, help the general market. So yeah, we've got a bunch of things to look at, and you've got two great questions here. One was the trend. I'm going to add the VIX index, because if the VIX goes back into the teens, the high teens, rather than into the 25 area, that's going to say that's buying pressure in the market, selling pressure in the VIX index. So we for me, I know exactly what we're looking for. Will we get it or won't we get it is the question, and the answer at the same time.
Sounds good. So would you nibble on any puts on the IBB out maybe through October, or would you wait?
So the question is, I've been saying that there's going to be a chance. We haven't done it yet. I'm prepared to give up some points, because I want to really get the next directional move. That is the move of 8 to 10 points on the IBB, correct? So as I said before, I'm prepared to wait, because if it cannot rally here from 358 into even the 363s by Monday, instead it starts to pull back and test the 353s, then my thinking is that at that point, by this afternoon late, you'll be able to tell. If there's weakness in the IBB, you can look out. I wouldn't go September. Of course, it's too late for that's tomorrow. I would look out into October, right, maybe November, in a put position on the IBB. I'd rather do it on weakness than on strength.
Sounds good. Thank you.
Thank you very much for calling, Mark. Appreciate it. Mark in Denver, and we were going through a bunch of things here, and I think that I think a number of the aspects were very important to listeners. Let's go through the GC. So we're looking at gold right now. What is going to be really important about the gold contract, because you saw the spike yesterday, was that just a technical spike, an oversold condition, an anticipation of things? Well, let's look at it this way. In the gold contract, and I'm just for the moment, keep looking at the gold contract. Look, if you can, scan from the left to the right, daily, weekly, monthly. As we go to the break, I want you to keep looking. You'll see that I'm going to the GLD. Slightly different chart pattern, not that much. And now I'll talk about it in terms of the monthly chart. What's so important about the next 20 to 30 points up or down in gold?
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN.
Before we go to the break, end of the show, and of course, by the time I see you tomorrow, you'll know a great deal more about what the Fed's doing, etc. And you've got great programming coming up all the day. You've got Daryl, you've got Dave, you've got, Daryl, then you've got Steve, then you've got Dave, and then you've got Tom O'Brien, then you've got Andy Heck, just programming all the way through. So they'll be discussing all these other aspects. I'm just going to make it real simple. The dollar. The dollar breaks down if all of a sudden it is not just spiking, it has to hold. If it holds below 94, it's at 95.28. If it holds below 94.65, that'll probably say that gold can go to 11.16 right now. Gold can quite easily go to 11.26 very easily. Okay. If the dollar, in fact, is impacted positively, and it takes out this downtrend line, starts trade at 95.84 to 95.90, so 95.27 right now, then what we will see is that gold will start to use this as a single leg A up, and it'll start to close at 111.16, and all of a sudden it's trading at 110 to 1110 to 1009. The TLT, make this real easy. The TLT has got a left side, right side price time match. It is so close to this support of, I should have typed it in, 117.66. If it closes the day, that means it has to go right through that 2 hours, the 2 hours after the Fed. If it closes underneath 117.32, in other words, it pulls back almost to 2 points, it's got, this is the bar, tomorrow is the bar that has the left side, right side price time test. If it takes it out quicker and closes there, it says, uh-oh, the Fed is going to cut. If it closes this is going even lower based on the MACD and stochastic being negative. If out of the blue, the Fed does something and it allows the bonds to move higher, TLT moves higher, 120.33 is a 9-period support. It can't just hit it and then pull back. It has to close above 120.50, and all of a sudden you'll see yields pull back again, and bonds go higher, and that's going to be really interesting. On the VIX index, that's probably even more important than anything else. The VIX index trading right now at VIX. Oh, what a day for Daryl to come on and talk about the left side, the upside and the downside. Oh, this is definitely the day. So here we are. We're looking at the VIX index. Hasn't gone under 20. There are people that are still nervous enough to be holding it up. Technically, this pattern, you've seen it so many times in the monthlies and the weeklies. You spike to the 28s. It even went to 53.29. So that's an overbought condition. But it's been working itself off very slowly. There's a lot of nervousness. If the VIX index just suddenly collapses and goes through the 19s and then it starts hitting the 18s, this market is going to spiral to the upside. Question is, what happens if the Fed does something, it indicates it, but it doesn't do it yet? That just throws a little monkey wrench into everything. And that's the scenario that says you get chop, 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 and then you close pretty much about where we are, all round. And then the market has to start fresh with a new worry tomorrow. So this is going to be really interesting. But the major parameters, volatility index at 2158, closes above the 2356 level. This market says it's going down. The VIX index going 2 points lower or more says this market is pushing higher. My bias right now is that we are due for just a little bit of a pullback somewhere. That's number one. And then we should go to slightly higher highs. That's what I've been looking at. And we were trying to play that H pattern. It didn't work. And that says that there's more internal strength right now than weakness. So the bias right now, regardless of a pullback, says we should go a little bit higher. And then we're going to see what happens. It could be a very volatile day. So speak to you later. Speak to you tomorrow. Good luck with your trading. Thanks for being here. Basil Chapman, Tiger Technicians Hour, signing off.
This coming Tuesday, September 22nd, Tom O'Brien will publish the 700th issue of his weekly newsletter, The Gold Report. It's amazing to think that Tom started his newsletter over 13 years ago when gold was trading under $300 an ounce. To celebrate the 700th issue, you can sign up right now at a 20% savings off the regular monthly price, and you can lock in that low rate for as long as you remain a subscriber. The Gold Report is Tom's weekly newsletter covering the gold market as well as a variety of gold mining equities. The Gold Report is published every Tuesday afternoon with a market update sent out to subscribers on Monday mornings. Tom will walk you through what's going on in the gold and metals market each week, as well as providing specific buy and sell recommendation on the mining equities themselves. Now is the perfect time to sign up for the Gold Report. The 700th issue is published Tuesday, and that's when this sale ends, so act now.
This is TFNN.